Okay, the lower of cost or market rule. This is a process for determining the value of something. So we choose, in this we choose the lower of the cost of something or the market and floor. Sorry, the market, which is between the ceiling and the floor price. This is a whole process. We'll go through it. So the market value is the replacement cost. We'll see this. The whole lower of cost or market approach. This is again a valuation sort of method. It's a more conservative approach to valuing and reporting inventory. So like normally ending inventory is stated at historical cost, right? So I buy, on Best Buy, I buy a bunch of TVs and I report them at their historical cost. However, when we sometimes have instances when the original historical cost of the ending inventory is greater than the net realizable value, then that means the inventory has lost value, right? So we need to revalue it, determine its value there. So these are a couple of points, and we'll go through an example, and it really won't make clear sense until we do an example, just like many things, obviously, right? But here, just a couple of points about the lower of cost or market rule. So the replacement cost must lie between a ceiling amount and a floor amount, right? So like the ceiling amount is the absolute most you can get for that good. The floor is the absolute minimum. The ceiling is the net realizable value. We're going to see this. So net realizable value, just like net realizable value of accounts receivable is AR minus allowance for doubtful, it's what you can really get for something. So what can you really get for this TV? Well, it's the selling price minus disposal cost, right? Any costs associated with needing to sell it. And the floor is net realizable value less a normal profit margin. We'll see these come together in an example. All right, so the lower of cost or market is an exception to the historical cost principle. So historical cost principle, if you remember all the way back from the beginning with our conceptual framework and everything there, this was, along with the matching principle, just the foundations that we build GAAP, FAR, FASB accounting. And right, we report assets at historical cost. However, this is an exception to this. So if, the value of the inventory significantly decreases, you need to restate the asset at the market to replace the cost. So whenever the value of the asset is less than its original cost, we're going to use the lower of cost or market approach. Here's a nice diagram, right? So this is a GAAP rule. And this is what we're going to be doing with our numbers. It's the lower of cost or market. So it's in the name, right? It's the lower of these two numbers. So let's say they just gave you a question. It said, hey, the market value is $2. The cost is $3. We would use the market value. Boom, done, easy, right? The only thing that makes this a little bit more difficult is that, so yes, cost probably be given to you. However, the market value you need to determine. And it's not just going to say 2. They're going to give you you're going to have to determine the ceiling price, the floor price, replacement cost, and you need to find the middle one here. And then that is your market. This is similar to a valuation topic in reg. If you've taken reg, you might be sort of familiar. It's similar to that process, like choosing the middle number. We will see this as an example and dive in a little bit further.